This segment is going to look at the use of the allowance method of dealing with bad debts. Because we cannot use the direct write-off method to follow generally accepted accounting principles, we are going to look at the use of the allowance method. And the allowance method, at the end of every accounting period, comes up with an estimate of how much of bad debt was incurred during the period, and that's going to be the amount of expense that is recorded. There are advantages to this method. It records the bad debt expense in the accounting period during which the related sale is also recorded, meeting that matching or expense recognition principle. It then also reports accounts receivable on the balance sheet at what we truly believe will be collected, or the estimated amount of cash that really will come in from those accounts receivable. So let's take a look at recording bad debt expense under the allowance method. At the end of its first year of operations, ABC Company estimates that $3,000 of its accounts receivable will prove to be uncollectible. The total amount of accounts receivable that they have recorded as of the end of December 31st, 2019 is $278,000. So of the $278 currently in their asset account, they know that $3,000 of it, or they estimate $3,000 of it, will never be collected. What the allowance method does is it records a $3,000 bad debt expense, or the estimate of how much will not be recorded and collected. The allowance account is a Contra asset account. Now, a Contra account, recall, has a balance opposite of the account it's tied to. The allowance for doubtful accounts is a Contra asset account tied to accounts receivable. Accounts receivable has a debit balance, so its Contra account is going to have a credit balance. So we will debit bad debt expense for $3,000 and credit the allowance for doubtful accounts for $3,000. When we do that, we will be increasing the balance in the allowance account up to $3,000 and recording a $3,000 bad debt expense for the year. When we look at the reporting on the balance sheet, we will see that accounts receivable of $278 is reported, but right along with it is its Contra account balance, $3,000, which offsets the asset's value. That means that the net realizable value, or the true amount that we expect our receivables to be worth, the company, is $275,000. If we had not recorded this adjusting entry for bad debt expense, we would have been missing $3,000 of expense for the year 2019, and we would overstate the value of our asset accounts receivable by $3,000. In order to come up with the amount of bad debt expense that is recorded each year, there's two methods that generally accepted accounting principles allow companies to choose from. The first of those methods is the percent of sales method, also known as the income statement method, and the other are the accounts receivable methods, often thought of as the balance sheet methods, and we will look at those in subsequent videos.